So hi, this is Archna Trades. I'm Archna and I'm going to be doing the butterfly trade. It's a name that makes everybody feel as though what am I doing? But it's a complex options trade. Uh, so I expect the people that are attending have some knowledge of options, but let's get right to it. So okay, so I'm giving a disclaimer right here. Trading is risky. All the trade setups and any information presented here or on my blog or my Twitter feed are not intended for any financial advice. It is only for educational purposes. These are merely examples of what I and other traders do on a daily basis and have found success. It is up to you what decision you take, how you manage your risk and capital. You should only risk the amount of capital that you can afford to lose. So let's go ahead. A little about me. I have been a successful trader for a few years. Other than trading, I've always loved teaching math. It's been a passion and a hobby. I still tutor kids. So I thought, why not take these two passions and I merged them and I started Archna Trades. I offer two products, and one is a Twitter Trade Alert subscription, and one is options mentoring, one-on-one program. Okay. Um, so mainly, I started as a technical trader, and then I did in 2012, I did options mentoring from Dan Sheridan. He's a veteran CBO market maker. So his style of options trading that I learned was mostly for weekly income. It was like he would do calendars and butterflies to get weekly 10% or 15% return. So, but then because of those strategies and the way they used to look at options weeks, I saw options not only as a tool for leverage or to be speculation, I learned options as an income tool. So I could not forget all the line drawings that I had learned and that had made me successful. So rather than just pick one or the other, I combined both styles of trading and made it my own. So I still look at the charts. I still do my drawings on the chart, but then I choose a strategy based on the Greeks. So let's go ahead and look about that. As I told you, butterfly is definitely a little more complex trade. So it needs some kind of knowledge of options. So I'm assuming that you guys have some knowledge of debit spreads and credit spreads. And at least you know what is a delta, right? Delta, theta, vega. So what is a debit spread? A debit spread is a way to limit profit, but it also limits risk. You are buying a call and then selling something against it. You're selling a call over it so that you are not having unlimited risk, in the sense the amount of money that you put in becomes limited. So you are limiting your profit also. Similarly, for a put debit spread. Now, why would you do a credit spread? Credit spread is you get upfront, you get the credit in the beginning, but it is you are trying to be little less directional. Why are you trying to be little less directional? If you think that the market is going down, you can just sell a credit spread on call credit spread, and then it doesn't matter, right? Unless and until it takes you out, your short is taken out. Until that time, you're fine. You'll make money if it goes down. You'll make money if it goes sideways. So just buying calls, just buying puts, you are being directional. You have to be right to make money. When you do a debit spread, you are trying to limit the risk, but you're still directional. When you start doing a credit spread, you are saying, I don't want to be entirely wrong. If I'm wrong, I'll still make some money. So you're trying to limit your profit, but then you are trying not to be wrong at all. Because you're not looking at the direction. You're trying to be less directional. So ultimately, when we talk about call, put, right, there are only two things. You can either buy a call, sell a call, buy a put, sell a put. So there's only so many things that you can do. It's a combination of this. All the strategies are a combination of these four things, either buying a call or buying a put, selling a call and a selling put. In what kind of combination you do these makes different strategies. Okay, so you have a straddle, you have a butterfly, you have a calendar, a diagonal. It just comprises of these four things. So when you will say, why should I do when I can buy a call, which is simple, why would I combine and try to make it complex? What is the purpose of doing something like that? The purpose is simple. When you buy a call, it requires you to be right in the bullish direction. It means that you have to be right. Whereas markets can do whatever it wants. The market is not asking me whether I should go up today. So that's why I want to try and eliminate the risk of my analysis. Buying a call, I have to be right. So what you do, you go ahead. If you're trying to sell a put, your assumption is still bullish, right? But then now you are eliminating, instead of being right all the time to make money, when you're selling a put, it just doesn't have to crash anymore. You can make money if it goes up. You can make money if it goes sideways, right? If it goes down, you still make money. It just doesn't have to crash. So when you're selling a put, what are you doing? You are trying to limit you being wrong. You're trying to limit the direction risk that you have. So in an attempt to reduce direction, we've increased the capital requirement though when you're selling a put, right? It requires margin. So what if I want to participate in the market? I don't want to be wrong, but I don't know what the market will do. So I'm trying to eliminate, okay? You want to reduce the direction risk. You want to reduce the capital risk. Then you try and combine these options, buying a call, selling a call together, and you're trying to combine them to reduce the risk, direction risk. So by reducing the direction risk, we are increasing probability of profit. For example, if you wanted to take Tesla short, okay, even right now it's at 1050 or so, right? Tesla. If you're trying to buy for this week 1,000 puts, you'll probably spend $1,000 to $1,200 for one contract, right? But instead, if you buy 1,990 put spread, you would probably spend only $250 per contract. So you are reducing the risk because you're reducing the capital outlay that you're initially doing. So by reducing the amount of money I'm putting in, I'm reducing the probability of loss. I'm increasing the probability of profit. Okay, so those are the reasons why we would try to do a debit spread or do any other complex strategy, is because I am trying to limit my direction risk, limit my capital requirement, and reduce the probability of loss. Because I don't know what the market is going to do. Yes, I can do my analysis, but ultimately, market can do whatever it wants. So let's see, what is a butterfly? It's a low risk, limited profit kind of strategy. It does not require much margin either. So it's a high probability trade. Okay, a call butterfly is you buy one call, you short two calls, and then you buy a long call. So right now, if you wanted to buy a Tesla call butterfly, current price is at 1050. Say you buy a 1060 call, you'll buy one of that. Say you want to sell 1070, but you'll have to sell two of this, and then you buy a 1080. Okay, so what are you doing ultimately? The 1060, 1070 together makes it a debit spread, called debit spread. Okay, so you have a debit spread first, and then you take the 1070 1080, that becomes your credit spread. Okay, so you're combining a debit spread and a credit spread together. Now, why is it still, this is a $10 debit spread, this is a $10 credit spread. So why do I say it is a debit trade? Because 1060, the one that we bought, is closer to the money, right? So this is going to be more expensive. So you have bought an expensive call here. You are selling two 1070s. So you're getting a huge amount of credit there. But the 1080 that you're buying, so that you don't have any capital outlay, you are looking, that is a cheaper one. So these two, you are buying two, you are selling two. But since the 1060 is very close to money, it's going to be a debit trade. Okay. So then this is the risk profile or the payout ratio. Okay. Don't think that this is anything complicated. It is just the way it is. So when you buy a call, the risk profile or profit is like this, right? Whatever money you've paid initially, if it goes down, you lose the entire thing. And as the market goes up or as the stock goes up, your profit becomes exponential, right? It goes up. So this is a long call. Okay. And then when we sell the 1070, okay, when you're selling a call, what are you doing? Whatever credit you got, that is the max that you can ever make. But the moment it goes below that, right? Once the stock goes above that price, your loss becomes exponential. So this is together a debit spread, right? Long call along with a short middle call. Now I'm combining that with a credit spread. The credit spread is you sell something and then you buy. So when you merge these two together, you get this, okay, risk profile. So if you, when I talked about Tesla 1060, 1070, 1080, okay, it's going to be like this. Okay, the moment it crosses 1060, my profit starts. At 1070 is over here. 1080, after that, I don't make anything. Okay, and I told you it's a debit trade. So this is for a call butterfly. Similarly, it's going to be the same for put butterfly. If you did a put, ultimately, if your stock is in between this body, okay, if your stock is in between this area, you're going to make money. So it may feel very complicated, but let's do, I have all examples. Now the underlying price movement, what you're trying to do, it has to be within that triangle range. That means you are still trying to be, you think it's going to be in up general direction, but where, how much, you are trying to still keep it in a range. The payoff statement looks like a butterfly, and as long as on expiration it is within this body, there is profit. Okay, the underlying price movement is expected to remain confined into a limited range. So there, that is the reason it is called butterfly, and there are specific times when you do a butterfly. You don't do butterfly every day. Okay, so let's take this example, Tesla. This I did it on 11/14. So, okay, this was this Tesla chart pattern over here. Okay, and you know Elon is going to sell or whatever. There is a gap down there. You think by this week it comes down and it tries to fill this gap at around 900, 920, right? So if you think the assumption is gap fill possible this week, suppose it closes on Friday, this coming Friday on 11/19 at 9:50, and you try to buy, this is as of 11/14, okay? The 980 put was $17. That means for per contract, you're spending $1,700. And if it goes to 950, you will make 51. Okay, so it will become 5,100. Good profit. I'm not denying that. But if you wanted to not risk $1,700 for this contract, you could do a debit spread. 970, 950 put debit spread was at around 370 on Sunday night. So if it closes at 950 this Friday, your 370 will become 20. Now look at what the butterfly costs. You are buying the 970 put, selling the two 950 puts, and buying the 930 put. It was for 70 cents. If it closes at 950, I can make $20, which means $2,000 for the contract. And I paid only 70 cents. Okay. So all those three trades. So if Tesla goes down, all those three trades are going to make money. Correct. So when the direction is right, buying calls is the easiest trade. There's nothing about it. You're not supposed to do butterfly then, right? But why am I choosing a butterfly in this instance rather than a call? Tesla has expensive options. So the price of being wrong in direction, okay? There's one tweet by Elon Musk and I lose the $1,700 because the stock would do something else, right? So Tesla has expensive options. So the price of being wrong in direction is high. I'm going to lose $1,700 for one contract. And because the options are so expensive and it's a volatile stock, Tesla usually has high IV, all the options, okay? So butterfly trade requires high IV. When it is highly volatile and the volatility of the options is high, I'm selling, right? I'm selling two options. So then because I'm selling, I'm getting a huge amount of premium. So the butterfly is very cheap. So all Tesla options, because they're expensive, and I'm combining some call long and some short, the entire trade becomes cheap. The way I look at the butterfly, okay, you could say, yeah, 70 cents to $20. It's huge profits, huge return on investment, right? So when I'm right, I make big. But the way I look at the butterfly trade, it's a low risk trade. I'm risking 70 cents rather than $17 for being wrong, okay? If I am wrong in a butterfly, it doesn't hurt because I'm not losing a lot. But if you buy a put in Tesla and your direction is not correct, you can lose big. So butterfly trades are cheap and they can make big if it is in your direction, if it is. So let's look at what are the ideal conditions for you to do a butterfly. I said that you need high IV, and yet you're expecting some kind of a range. Here, I'm thinking that Tesla will try and fill the gap. So I know the general direction where I think it is going. It has high IV, and I still think that the dip is going to get bought, so it will still remain in a certain range. These are the conditions it has to meet for me to think about doing a butterfly. Another reason why would you do a butterfly? Okay, I don't know what the market is going to do in 2 months, right? But what is the general feel about the news, about the charts, about all the technical setup for a week or two? Yeah, that I can probably predict. So for a butterfly, very short duration for this week, maybe next week, not more than 1 or 2 weeks is what is required. Another reason why, because I am selling, I want the entire premium, okay? The only way you make money in butterfly, it has to be within that triangle that we saw within the body of the butterfly, and you're expecting the entire 1070 put that you bought, sold, that premium to decay. So you are looking for short duration trade with high IV and still having some kind of a range. So it is very ideal for earnings. While when I'm saying earnings are uncertain, you don't know, it can gap down, gap up, right? So how with that uncertainty, I'm saying that butterfly that makes money if it is in a range, how is that ideal? Earnings gives options high IV. Because of earnings uncertainty, you're looking at it has very high IV. After the announcement, after the earnings come out, there is so much collapse of that risk premium, the volatility comes out, that if you're in the general direction of the stock, profit making is easy. Another reason why would you do a butterfly is a pinning butterfly, okay? So if you look at Tesla or any of that and say $1,000 at that price, there's so much option open interest. So probably Tesla pins there. So when you think that based on all the option flow and on Friday, it tries to get there. So all the premium of all the options around it have to become zero, right? Because anything that is out of the money on expiration is going to become worthless. So that passage of time also collapses the IV, and that reduces the option premium. And that is how you can, passage of time also collapses IV. And if the butterfly, if your price is within that butterfly, your trade is profitable. So these are two scenarios: earnings, pinning, and if you have high IV and you know the general direction, these are the times to do a butterfly. So let's say we have Nvidia earnings coming, okay? So this is what it shows. I told you I'm a technical trader, so I'm going to look at the chart and I'm looking, okay, this is the expected move of Tesla, of Nvidia. So much Tesla I'm talking about that I'm just talking about Tesla. This is Nvidia. So 316 is the upper, 284 is the below. This is the expected move based on the prices right now. Okay, and the previous few times, okay, it has 4% move once and it usually gaps down. I don't know what it's going to do, but this is what I see. So what? I don't know the direction. It can gap up, it can gap down. So why not do a put butterfly and a call butterfly in those general vicinities close to the expected move? Okay, so I scheduled, this is what I did yesterday. Nvidia call butterfly at 310, 320, 330. We saw the expected move is at around 316, right? So I'm trying to put a call butterfly there for $1.07. Then a butterfly at the lower 284, maybe it pins there, 295, 285, 275. The total debit is 254 for both the butterflies. So I don't know what direction I'm not taking. If it gaps down, I'm fine with it. If it gaps up, I'm fine with it. If it gaps down to the expected move, I'll make around and comes to the 284 price, I'll make $10 here, right? I'll make close to $10 here because this is a $10 white butterfly. I'll make $10 here. This $1 will be gone, right? If it gaps up, I'll make money here and this will become zero. So you can have 254 and anywhere it close to this, I can probably make $10. Because I paid 254, my break even is $2.54 above the price. So that means it has to be on Friday. If it goes up, if Nvidia goes up, it has to be about 312.54 for me to make money. If it goes down, it has to be 295 minus $2.54. So you're looking at it has to be 292.46. Okay, if it is anywhere there below 292, I'll make money. Okay, now there is one way. If you have a bias, here I'm saying I don't know what Nvidia earnings are going to bring. I don't know whether it gaps up or I don't know whether it gaps down. So I'm taking a put and a call butterfly. I could just, if I have a bias, say because of all the chip shortages and everything, and Nvidia is a name, it gaps up. I don't need to do, if you have a bias, you don't need to do the put butterfly, just do a call butterfly for $1, right? For $1, you're risking $1 and you can make 10 bucks. So this is a cheap way of playing earnings rather than just trying to buy a call where the IV is so high and you're paying so much money for it. Okay, now that was how to play earnings. Let's think about a pinning, how to do a pinning butterfly. Okay, Shopify, if you look at it, okay, I was looking at it, the highest volume it had on the 1700, 1750, and then 1800. Okay, you can see over here the option itself. Okay, the volume, open interest shows you where there is a lot of activity. So if this is where people are trying to buy, right? If that is where people are buying, why not take advantage of that? What does the market maker try to do, right? Market wants, sometimes you will see there is so much option volume there, it will try to get there, but it will not get there because it wants everybody to keep holding, thinking that it will go there. And by Friday, it won't go there. And so all the premium is gone. It must have happened to you. It always happens to me, okay? So what I'm trying to do, okay, the Shopify had on Friday a big move up. It has the 17, 1750, all these areas called strikes. It has a lot of, probably it pins at 1750. That is my assumption, okay? With this assumption, I am taking a trade. So this is where this is a Friday, right? It gapped up almost, it did $100 move on a Friday expiration. It was on Monday, a small doji. This is a fib support at around 1750. If it has a one or 2 days of up move, it gets there, right? Right there at 1750. So the options, their open interest and volume shows activity there. The fib support is, the fib target is there at around 1750. Probably this Friday, it pins there. This is my assumption. So I am taking a 1720, 1750, 1780 call butterfly. I have this trade right now in my trading platform. Okay, so my setup is bullish. Okay, and a possible pin of 1750. If it pins anywhere close to 1750, I can make $30. Okay, and it can be, yesterday it showed $1.65, but I got filled for it at 190. Okay, so I've paid $1.90 for one option contract with the potential to make $30. What if it doesn't go there? I won't make, I'm not risking. If you look at it, you're talking about 1720 option price is around 30 bucks, 20 bucks. I don't want to waste that much, okay, for being wrong. Yeah, right now 1720s calls are at 20 bucks. I am participating in a stock which has very expensive options very cheaply with small. So account size is not going to be a matter for doing these kind of trades. Butterfly makes it easy for even a small account to participate in stocks like Amazon, Shop, and Tesla. So because I am over here, the example says $1.65, right? So as long as Shop on Friday, because I've taken this week expiration, 19th November, 1721.65. If it is above this, it has to be below. You have to subtract from that 1780. Okay, at 1778.35, I'll be profitable. If it is close to, right? So if you look at it, this part, 1720 to 1750 is the debit spread. And 1750 to 1780 is the credit spread. So say I'm in the central time zone. So at 2:55 central time zone, 5 minutes before market on Friday closes, on expiration, Suppose shop is at 1750. This entire debit spread is full profit, right? You have the right to buy it at 1720, but you have to sell it at 1750. So your max profit of $30 is there. Now the credit spread says 1750. You have to sell it at 1750, but you can buy it at 1780. So the credit spread, whatever credit you got, is all evaporated because only 5 minutes of time is left for expiration. So at that time, if it is at around 1750, it will still not be. You still have those 5 minutes, right? Time has value. So you won't be able to sell it for exactly $30, but 29, yes, I would be able to easily sell it for $29. So I spent $1.90 and I can potentially make 29 over here, okay? And right now, if I look at my account, I'm already double. So it's already up there, okay? So if I want, I can just take a double and be done with it. So I'm not putting a lot of money at risk to be right. So to sum it, butterflies can be used as a low risk directional trade when IV is high, or you are trying to do a short duration bet. The way I use butterfly setup I showed you, I take into account the technical setup. That is what I started. That is how I learned trading. So I have to look at a chart. That's just me. But then I will look at the options, open interest, volume, and the IV of the stock to decide whether I should do a butterfly. So if you have any doubts, you can ask me, or if you have any questions, you can ask me. This is what I can offer you, that I offer options mentoring and Twitter trade alerts. So if you use the coupon code until next Thanksgiving, until this next week, give 50, you will get 1 month off, 50% off for the first month. Any questions? I can go over everything. I have the Tesla trade running, not for this week though. This is an actual trade that I have, but I have configured it for next week rather than this week because today it was gapping up. So I have this, but for next week where I paid $1.10. This is a live trade. This is also a live trade that I have right now. Anything you guys want, I can answer. I'm hoping that you have some questions to ask.
Is that the background on that you keep on your desktop? Is it just different industries that you keep track of, or?
Yeah, this is just my desktop. Yeah.
Okay, that's cool.
How much of your options trading is butterfly? I don't do that many right now. Earnings finished, so it's mostly going to be only when IV is high, right? That's when I do. It's usually earnings, and sometimes when there's this kind of gap fill where I definitely see, that's when I do. It's not usually a thing that I do. Yeah. So I don't do only butterflies, right? No. Meme stocks, butterflies, no way. Why would you do that? Okay, so the main thing that I did not say, okay, what happens if Tesla does not stop at 900? 950 is where I'm planning that it will pin, right? What if it goes to 900? What if it goes to 850? Your debit spread and your credit spread both are in the money. So at that time, how much ever I paid, that $1.10, I would actually have to pay probably $1.20 or $1.30 to get out of it. Yes, but when you high IV on memes, but can you, I still said, right, there has to be some thesis, some kind of range. You are trying, it has to be within that triangle. What kind of triangle you can do, right? So, I mean, there are people, when I learned, they do butterflies, weekly butterflies on SPX. So right now, SPX is at 4,700. They would do a 4,700 pinning butterfly with the wings going to be at 4,600. So if it moves anywhere within the $100 range, you can make money. So they are just looking at collapse of IV. That kind of butterflies can be done, but then you're putting a lot of money. It's not going to be cheap. So it's more like you're doing a straddle and then just buying the wings for margin sake. Those kind of butterflies I don't do, because I don't want that kind of. Here, I'm just saying a $30 buy. You can do GameStop. You didn't know where it can go. No, that is not the right time to do. It's still, you're talking about a range, right? Where you need to know a range. Butterflies work best in high IV, but it still you'll know where the range is. Without the range, there's no point. If your debit spread, if Shopify does not go up, I'm losing, right? But I'm losing only one. So yes, range is the most important. High IV and range. That is the reason I am, when you're looking at the Nvidia earnings trade, I am not randomly choosing those, what strike to sell, what strike to buy. That's not random. I am looking at the expected move. Okay. That is what I did over here. The expected move is exactly telling me based on the IV right now, how the options are priced. Based on the option price, the straddle when you sell, okay, it is saying that the expected move is going to be at around 316, right? Around $20 expected move is there in Nvidia. That is the reason I am targeting that price. Yes, this is advanced level. For beginners, options, trying to get comfortable with buying calls, buying puts, because yes, you are talking about being right in direction, but then you know exactly when you're buying a call or buying a put, whatever money you've put in, that is all that you can lose, right? But with all other strategies, there are margin requirements, and so you need to know how to adjust. So if I do a calendar, I know how to adjust. If I do a credit spread, I know how to adjust. If I sell a put, I know how to adjust. Yes, with high IV, you're talking, it has wide range. Yes, that's why I'm saying it is not an everyday trade. Yes, it's not an everyday trade. It's specifically if you are looking at pinning, right? It's so obvious when if Tesla is stuck for the last 2-3 days at around 950, right? The chance of it going to 1,000, where there's so many people trying to buy calls, that is where the pin is going to be. So then you're trying to play the pin. Yes, it is difficult. It is a low probability trade. Butterflies are not high probability trades because it is very difficult to pin. It is very difficult to know exactly what range, especially with this kind of environment where one mention of one tweet by Elon or Wall Street bets and things go haywire. It is very difficult to pin. It is not an everyday trade. The only way I do it is an earnings trade where I want to play earnings without risking a lot of money. Okay. So like Home Depot, I did an earnings trade. I bought January calls. I did not try to do an earnings trade in a butterfly earnings trade on Home Depot. But Nvidia, it has ran up so much already, right? So this is how I think Nvidia has ran up a lot, but all the Qualcomm gapped a lot on earnings. It gapped up huge on earnings. So that is the reason I'm like, it can gap up because Qualcomm gapped up, but Nvidia has ran up so much. So it can gap down because most of the earnings recently, stocks that have ran up, even if their earnings are good, they have been gapping down. So I'm looking at what has the market given as of now in earnings. I have no edge. Yes, but retail was good that I knew. Home Depot, I was comfortable going long. So I just took a call on Home Depot, January expiration. But when I have no edge, but I still want to play Nvidia, I'm going to be putting what? Nvidia earnings. I may just take a $1 call because Qualcomm is still running right now. Today it has been running. And all the chip shortages recently, Ford and other companies said that it is easing. So probably it runs up. If Nvidia says there's no chip shortage for us, we are doing everything good, it can run up. So that's the only reason everybody thinks it's going to be the next $1 trillion company. So I want to go long, but I don't want to spend that much money. I can spend $1, right? So it is more speculative. Butterflies are more speculative, low probability trades. But it's something that keeps me engaged once in a while when things are not going very well, right? So that's how it is. I have made money. That is the reason I am showing this trade. I have made money. I showed you I have Shopify. I bought this for $1.90. Before I logged in, I already had more than, if I'm looking at it right now, I'm still up almost $100, right? I paid $1.90. The way Shopify, if it does not move one day, imagine the amount of loss it's going to be on your simple calls, right? When I was talking to you, when I was explaining Shopify, 1720 calls were $20. Right now it's at $19. Okay, it's done nothing wrong. It's just moved down a couple of bucks and you were already down 10, right? You're already down $1. So, but I just put in $1 some change. So it's a cheap way of playing a pin, cheap way of playing earnings, where I have made money. I make quite a bit of money on these trades, but I don't do it every day. It's not an everyday trade. It is specifically, right? So now probably think about it. Everybody's talking about 5,000, SPX 5,000. And if we are nowhere close there and December 31st, right? Why not try 5,000 type of, if we are anywhere 4,800 somewhere, if you do an SPX 5,000 December 31st butterfly, it makes sense. Logically, it makes sense to me. If the options and all those things also line up, I'll do. It will cost me some $100 here or there, and I'll take a shot. So it's a cheap shot. That does not require you to manage it. You just have to wait for expiration day, that also afternoon of the expiration day. This is the simplest butterfly. Now, yes, people do unbalanced butterflies, broken wing butterflies, all those things. I do quite a bit to have my income. I told you, right? It's an income trade. That's how I learned it. So you do a $10 debit spread, but do a $20 credit spread. You're using margin, but then it's a credit trade. If it goes up, you make money. If it goes down, you make money. If it goes sideways, you make money because you got credit initially, right? So unless and until it blows through, you're short, you're going to make money. So that's how you can keep making your 10% weekly. So doing unbalanced butterflies or broken wing butterflies, that's more complex. That cannot be taught in this session. So those are different. Any other question? If you, I mean, and if you can see, don't think that this is too complicated. This is just to show. But yeah, it's over here. Tesla is right there. It has the 50-day, it has the gap. So things are lining up. When things line up is when a butterfly makes sense. Otherwise, they don't. Any other questions? Where can you put 70 cents and make $20? You tell me. So, right? If Tesla does not move for 5 minutes, you're lost 70 cents in your option. So, even if you try to play just buy outright stock, you can lose 70 cents. So it's just a cheap shot. That's all I'm trying to say. So I'm done